Interview is Dallas Fed President and Fed voting member Robert Kaplan. Great to have you here, President Kaplan. So we had this big growth spurt in the economy, and now we appear to be slowing again. How slow do you expect the economy to go down now with this virus surge?
We've been growing, as you point out, since April. That growth has been moderating, and we could get to the point, depending on how significant this resurgence gets, that growth would actually stall out either by the end of this year or into the first quarter. The positive news is over the horizon with the vaccine, we expect very strong growth next year. But I think the next 3 to 6 months is going to be challenging, and it appears to us that growth is decelerating, and if this resurgence keeps heading the wrong way, which it is, that slowing and deceleration could get worse.
Does that mean that the Federal Reserve should step up and do more in terms of stimulus?
I don't know about that. Economic conditions, financial conditions, should say, are very accommodative. The one area they're not particularly accommodative is if you're a small business that's very reliant on bank lending and you're in a person-to-person contact industry. But otherwise, financial conditions are very accommodative. And I think when you have this kind of situation where you've got a 3 to 6 month issue, but over the horizon, we expect strong growth, I think dealing with that may be more suited to fiscal policy that can be more targeted and maybe more suited to that than monetary policy.
Your challenged outlook for the next 3 to 6 months, does that rest because of the virus cases spiking or because of the lack of fiscal stimulus? Or would either of those changing direction make you more constructive even in the short term?
It's primarily because of the virus spiking. And what we're concerned about is what we're seeing, and we track at the Dallas Fed mobility engagement literally in every county, every city in the United States. What we're seeing is the population is learning how to go about their business despite this resurgence, and they continue to do that until resurgence in a city gets so bad that it threatens availability of health care. And what I'm worried about is if this virus resurgence keeps heading the wrong way, you'll have cities increasingly that have to deal with tough decisions about how to maintain access to health care. So what's an example? El Paso is an example of a city that had to put new restrictions on because they lost health care capacity. That's the primary concern that I'm seeing. Obviously, to the extent there was fiscal support, that would help moderate that impact. But the primary driver of the concern is the virus.
Are you surprised, President Kaplan, that the market, the investors have largely looked through the short term and this virus surge and the slowdown in growth into next year, into earnings and economic growth that you talked about should come as a result of a vaccine? Or is that the right way that we should be thinking about it?
Yeah, so the market tends to look over the horizon and has the ability to discount events a year from now, 2 years from now, and 3 years from now. And there's no question that our base case of the Dallas Fed is that GDP growth next year could likely be in excess of 3.5%. So we're going to have a very solid year of growth next year. A good part of it, though, is going to be back-end loaded, in the last 2 or 3 quarters of the year. And so the market has the ability to look over the horizon, even though the economy, I think, is going to be challenging for the next 3 to 6 months.
Coming back to what you said earlier, that you think that the current threat to the economy is probably more suited to being fixed by fiscal policy, do you not think it would be sensible to increase bond buying or to lengthen the maturities of bond buying in the short term?
I would not want to do that at this point. I'll go into the December meeting with an open mind, but I think we've got very accommodative financial conditions. We've got historically low rates on the long end, and so I don't know that increasing the size or extending maturities our bond purchases would help address this situation I'm concerned about over the next 3 to 6 months. But again, as always, I'll go into the meeting with an open mind, an opening to listening to counter arguments to that point of view, and then making a decision. But that'd be my view going in.
Shepard Smith here. Thanks for watching CNBC on YouTube.